The tariff slowdown has begun. Bookings of container shipments from China to the U.S. are down nearly 50% compared to a year ago, according to shipment tracker Vizion.
Empty cargo containers coming into the United States. We're now seeing over 30% of a decline in the amount of imports that are coming in from China.
Over $10 billion worth of U.S. cargo just got blocked at China's busiest port. And Beijing says it's just a routine inspection. But shipping experts are sounding the alarm, warning this is the start of a dangerous new chapter in the trade war. Supplies for your smartphones, electric cars, and critical medical equipment are stuck at sea, sending prices soaring and store shelves empty. Wall Street is already shaking and U.S. supply chains are on the brink of collapse. This isn't a delay. It's economic warfare. On April 19, 2025, China's busiest shipping hub, Shanghai Port, suddenly delayed over $10 billion worth of U.S. cargo. The official explanation: routine environmental and safety inspections. But industry veterans weren't convinced. Experts from Freightos and Drewry were quick to sound the alarm, calling it a calculated economic strike in disguise. Shanghai isn't just any port. It moves nearly 47 million containers a year and handles about 17% of China's total trade. Shutting it down even partially sends shockwaves through the entire global system. But this time, it wasn't soybeans or toys caught in the gridlock. It was America's high-value lifelines: semiconductors, electric vehicle parts, and critical medical supplies. Within days, analysts reported a 20% increase in backlogs at key U.S. ports as containers arrived without unloading capacity. And unlike formal tariffs, China's move skirted World Trade Organization rules, making it nearly impossible for the U.S. to respond through legal channels. This is what experts call a soft strike: silent, targeted, and devastating. It wasn't loud, but it was lethal to U.S. supply chains. Beijing didn't need to announce a new policy. They simply applied pressure where it hurts most. And as a result, American industries are now scrambling to contain the fallout. This wasn't a delay, it was a message. And that message? China's willing to weaponize the ports. China didn't randomly delay cargo, it picked its targets with precision. The containers blocked at Shanghai weren't full of low-value goods. They held high-stakes shipments that power America's most critical industries. Over 70% of the materials used in U.S. electric vehicle batteries are sourced from China. That includes lithium, graphite, and rare earth minerals, items you can't just swap out or reorder from another country overnight. Tesla, Ford, and General Motors are already warning of production slowdowns due to delayed battery components. But the pain doesn't stop at cars. Roughly 40% of America's syringes and 30% of its diagnostic kits also come from Chinese manufacturers. As flu season approaches, hospitals are flagging shortages of basic but vital supplies, right when demand is set to spike. The CDC even issued an internal alert urging providers to monitor inventory levels more closely. On the tech side, it gets even more fragile. iPhone 17 production is now facing serious setbacks. According to Nikkei Asia, pre-order timelines could be pushed back by up to 2 months, with downstream effects on accessories, repairs, and global sales cycles. And let's be clear, none of this is a coincidence. By targeting tech and healthcare, China is hitting America where it's both economically and politically vulnerable. It's not just a trade tactic, it's a surgical strike on sectors the U.S. can't afford to lose. In April 2025, President Donald Trump escalated the U.S. China trade conflict by imposing a sweeping 145% tariff on Chinese imports, a move that significantly disrupted global trade dynamics. This action led to a 60% drop in shipments from China to the U.S., with 30% of sailings canceled, causing widespread supply chain disruptions. Further intensifying the economic standoff, the Trump administration announced new port fees targeting Chinese-built and operated vessels. Starting October 14, 2025, these ships will face fees beginning at $50 per net ton, increasing annually to $140 per net ton by 2028. The policy aims to reduce China's dominance in global shipping and bolster the U.S. shipbuilding industry. Despite concerns from industry stakeholders about potential inflation and supply chain bottlenecks, President Trump defended the measures, suggesting the port slowdown reflects a necessary rebalancing of trade in America's favor. These aggressive trade policies have led to significant economic repercussions, including a projected 35% decline in import cargo at the Port of Los Angeles and a 20% year-over-year drop at the Port of Long Beach. The administration's actions mark a new chapter in the ongoing trade war, with far-reaching implications for global commerce and economic stability. In response to China's port delays and rising trade tensions, the U.S. is investing heavily in domestic manufacturing. Through the CHIPS and Science Act and the Inflation Reduction Act, the government aims to cut its reliance on foreign supply chains, especially for semiconductors and EV batteries. The CHIPS Act, signed in 2022, allocated billions to boost chip production. Hemlock Semiconductor, for example, received $325 million to build a new plant in Michigan to produce power and sensor chips. Meanwhile, the Inflation Reduction Act offers tax credits for EV battery makers, with stricter rules pushing more local sourcing. But despite these steps, China still dominates the market. KTL and BYD lead global EV battery production, and China controls most of the rare earth minerals essential for electronics and clean energy. These are not resources the U.S. can replace easily or quickly. To make matters worse, air freight from Asia to the U.S. is down 20 to 30% year over year as importers try to avoid higher tariffs. Shipping from Vietnam and Cambodia is also more expensive, making diversification harder than it looks. Analysts warn that a full trade decoupling from China could cut U.S. GDP by 1.4%, hundreds of billions lost. Meanwhile, China is deepening ties with Europe and Asia, offsetting losses from U.S. trade. America's road to self-reliance is real but rough. Whether these investments pay off or fall short will define the next decade of U.S. economic power. While ports are choking and factories are stalling, the financial world is already reacting, and the signals aren't good. In April and May 2025, semiconductor ETFs like SOXX and SMH dropped between 6% and 12% as traders braced for chip shortages. Shares in major shipping companies, including Maersk and Zeeman, plunged as container backlogs worsened. Even retail giants like Walmart, Tesla, and Apple saw sudden stock dips after issuing supply warning updates tied to the Shanghai bottleneck. According to Bloomberg analysts, this wasn't just a short-term blip, it's a signal of deeper market fear. One report noted, investors see this as a preview of 2026 decoupling risks. With global portfolios already shifting toward lower-risk emerging market supply chains, in fact, capital is now flowing into economies like Vietnam, Mexico, and India, nations seen as safer bets amid the escalating U.S. China trade standoff. Meanwhile, U.S. Treasury yields have climbed as inflation expectations rise. With supply chains under pressure and shipping costs spiking, investors are bracing for price hikes that could push the Fed to stay hawkish for longer. In short, while Washington debates strategy and Beijing flexes economic muscle, Wall Street is already adjusting. Money moves faster than cargo, and right now the smart money is steering away from the chaos. This isn't just a trade war, it's a market reckoning. As China tightens its grip on global trade, the Trump administration is now racing to close America's supply chain vulnerabilities. Many of the current efforts, like semiconductor and EV battery production, stem from laws passed during the Biden years, including the CHIPS and Science Act and the Inflation Reduction Act. But under President Trump's second term, the focus has shifted from investment to acceleration and protection. The CHIPS Act, signed in 2022, is now funding major projects like Hemlock Semiconductor's $325 million expansion in Michigan to boost U.S.-made sensor and power chips. Meanwhile, Trump officials have signaled they'll tighten oversight and redirect funding toward projects that reduce dependence on Chinese components more aggressively. Still, China holds a commanding lead. Over 70% of global EV battery supply and 80% of rare earth mineral exports come from China. Companies like KATL and BYD dominate the battery market, and the U.S. still imports key materials used in smartphones, military tech, and clean energy from Chinese sources. Adding more pressure, air freight shipments from Asia to the U.S. have fallen 20 to 30% since Q1 2025 as companies slow imports to avoid higher tariffs and regulatory risk. Shipping costs from Vietnam and Cambodia, intended alternatives, are also up, hurting small and mid-sized importers. Trump's team has floated additional tariffs and even expanded port access restrictions if trade talks with Beijing collapse entirely. But economic analysts warn that a full U.S. China decoupling could cut up to 1.4% off U.S. GDP, a blow worth hundreds of billions of dollars. China, meanwhile, is not slowing down. It's sealing deals across Europe and Southeast Asia and building its next generation of supply routes beyond U.S. influence. The Trump administration faces a hard reality. It's no longer just about rebuilding America's industry. It's about surviving in a new era of global economic warfare. What started as a cargo delay is now spiraling into a full-blown economic Cold War. U.S. lawmakers on both sides of the aisle are no longer treating trade as just commerce. It's national security. That's why Congress passed the Ships for America Act, designed to rebuild the American shipbuilding industry from the ground up. The logic is clear. If the U.S. can't move its own goods without Chinese-built ships, it risks losing control in future global conflicts. The numbers are staggering. China builds over 1,700 ships a year. The U.S. builds fewer than 10. That gap isn't just economic, it's strategic. And in a world where shipping lanes can be weaponized, China's dominance at sea is now a geopolitical threat. Meanwhile, China's state-backed shipping giant COSCO is already feeling the heat. As U.S. port fees and tariffs rise, COSCO is struggling to reroute its massive fleet. Analysts at Reuters warn it could become the first major casualty of the new shipping war, but the consequences go far beyond cargo. Higher freight costs, reduced competition, and fragile logistics are now a global concern. And the risk of a flashpoint around Taiwan or the South China Sea is growing. If China chooses to extend these soft strikes into military zones or allied shipping routes, the consequences could explode overnight. Supply chains used to be seen as neutral global systems. Not anymore. They're now battlegrounds. And if current trends hold, the 2025 Shanghai shutdown may be remembered as the opening move in a much larger geopolitical clash. China didn't just block cargo, it delivered the first major move in a new kind of economic conflict. From rising prices to shaken markets, this is no longer just about trade. It's about power, control, and who sets the rules of the global economy. Subscribe for powerful weekly updates on global power plays, trade wars, and what's coming next. Don't forget to like, share, and leave your take below.